Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'm going to include a Q&A session. I've only got one question to answer at this point, but if you have any questions, just to kind of create a little bit more interaction in this podcast, if you've got any questions, send them to me at questions@investopoly.com.au and I will endeavour to answer them in this podcast. I might not be able to answer all of them, but if you send them to me and I think they're really relevant, I'll certainly enjoy having a go at sharing my opinion on what the right answer might be. So let's get into today's episode then. It's really related to the cost of living crisis, and I think a client conversation I had last week for the idea to write about this. But it's been well documented that prices have, cost of living has increased quite considerably over the last 4 years. I can't believe it's been 4 years since the start of the pandemic, but really the time period that I'm really referencing during this episode today is really from the beginning of 2020, which is really the beginning of the pandemic, until now. So there's two potential consequences of the cost of living crisis that we were discussing with my client. The first one is that if you're spending more on day-to-day living expenses, arguably it means you've got less money left over to invest, and that can significantly impair your ability to build retirement funds perhaps. And then secondly, if you're keen to maintain your standard of living through into retirement, which most people are, of course, then arguably you need more money at retirement as well. So it's kind of a bit of a double-edged sword. You've got less to invest between now and retirement. Meanwhile, you need more at the time of entering into retirement to be able to maintain that standard of living. And so that's what I wanted to discuss in today's episode. So if we look at the general measure of inflation since 2020, CPI, it's up 17.6% since the beginning of 2020. And if June quarter inflation comes in, around about 0.8, 0.91%, which is kind of the range which we all expect it will, that increase will blow out to 18.5% since the beginning of 2020. Let's call it 20%. Just general CPI is up 20%. However, anyone that's walked down a supermarket aisle over the last few years will know that prices of many goods and services have increased substantially. I mean, just anecdotally, the sandwich shop that I go to every day, yes, I go to the same shop every day for lunch, almost. I know I'm a boring accountant, it is what it is. Anyway, I used to pay $6 for that sandwich, and now it's about $9.40, I think, or something like that. That means that the price of the sandwich increased 50%, but I don't think they're profiteering. I think that cost increase is probably due to lower traffic, because of work from home, less people in the city, a higher ingredient costs, of course, like the raw materials to actually make that sandwich, and then wages. Wages have increased substantially as well. So whilst they've had to hike prices by 50%, I don't necessarily sit back and think they're making a lot more money as a result of those price increases. So I had a conversation around the office around, okay, what are we doing to combat this? Like if a lot of prices have increased by a lot more than 20%, like my sandwich story, does that mean, have we seen that in our budget? And what I learned is that a lot of people have changed their spending habits to try and combat this increased cost of living. So, buying in bulk when things are discounted, buying more non-perishable items from places like Amazon or so forth, like washing powder and those sorts of things, opting for cheaper brands or substituting products, buying a different type of product in terms of like for snacks or something like that. So people have proactively, it seems like as a general rule, in fact, there was no real exceptions, proactively tried to change or have changed their shopping habits to sort of stem the impact of these rising prices. But of course, you can't avoid it completely. There's going to be compromise you don't want to make, or a non-discretionary expense like energy, insurance, mortgages. There's not much you can do. I mean, you can shop around, of course, but beyond that, there's not much else you can do to avoid the price hikes over the last few years. So whilst we can point to plenty of items in the supermarket that have increased more than 20%, I think 20% is probably the right number to work on in terms of the cost of living change between 2020 and today. Now, of course, everyone's situation is different, so it's quite possible that your cost increase is less than 20, and of course there's going to be people with more than 20, but I think 20 is kind of the right number to use in our analysis. business. So as I said at the beginning in the intro, there's two potential consequences of this cost of living. One, you've got less money to invest, and two, you need more money at the time you start retirement in order to not compromise on your standard of living. So let's talk about them a little bit deeper. It's true that costs have increased. As I said, we concluded 20%, but income's increased too. So if you look at the wage price index, which looks at the average sort of income over Australia, so it's going to be different for different occupations and situations and so forth, but that's increased by just over 11% since the beginning of 2020. So at least incomes have increased, and of course your expenses might account for, maybe 30 or 40% of your income. And so 11% increase at the top line, would go a long way to sort of offsetting that sort of 20% increase, except for mortgages, of course, because we're just looking at, goods and services, not really mortgages. Obviously, mortgages have increased substantially. So I still think people's cash flow position has greatly reduced between 2020 and today. And I would also say it's true that certainly across our client base, people have less investable cash flow today than they've had over the last number of years. So there's certainly an issue here, or certainly a change that we need to address. Now, the second impact is you're going to need more money in retirement to enjoy a very comfortable retirement. Going back 4 years, everyone used to quote this magical $100,000 a year. I need $100,000 a year to have a really enjoyable standard of living. And a lot of people kind of use that number. It's not necessarily wrong. It could be right. It's probably right for most people. I mean, maybe it's a bit high for the average Australian, but certainly most of the people listening to this podcast, it's probably right. So if we assume then that cost of living's increased 20%, your $100,000 a year is really $120,000 a year, sort of in today's dollars. So if you plan to retire at age 60, spend that 100 or 120, depending on which numbers we're talking about, through to maybe 80, but still have enough money to live through to 95. Let's say you, instead of spending 100,000, you spend 70,000 through to age 95. Now, not all of us are going to live to age 95, of course, but you make sure you want to plan so that you're not going to run out of money. Well, previously, when you only needed $100,000 a year, you needed just over $2 million to fund that $100,000 I've just spoken from age 60 through to age 95. With the 20% increase, you're going to need about 20% more. So, close to $2.5 million. So it's true that you're going to need to have more money by the time you get to age 60, 65, whatever your target retirement age is, and that it's going to be more difficult to get to that number because arguably you've got less investable cash flow today because of cost of living, because of higher interest rates. So as you're listening to this podcast, I can hear you thinking, okay, Stuart, what do I do about this? And that's fair enough. That's a good question. That's why I'm here. So the first thing is spending is invisible. We've got to try and make it visible. I'm a big fan of Seth Godin, who's a blogger, an entrepreneur, a marketing genius, if you like, written heaps of books. If you like blogs, Google Seth's blog because he writes it every day. It's really interesting. Anyway, he wrote in his blog, and I quote, "We're not very good at paying attention to invisible or gradual outputs. The trick is simple. If it's important, make it visible." And the truth is that much of our spending is invisible. It's numerous small transactions, and conceptually, as human beings, we have difficulty in sort of conceptualizing, a whole bunch of different transactions at different amounts, what they might look like in aggregate. And also there's things like direct debits and credit card payments and automatic payments and these sorts of things that they kind of go unnoticed. They just come out of our account without us really thinking about it. So in order to be able to manage cash flow, which is a critical step in building wealth, you need to make it visible. You can't manage what you don't measure. And it's a practice that I've maintained for many years. What I do is look at our expenses every month and I track and allocate the expenses that we're most likely to overspend on. And there's only a handful of them. So it's wine for me, although I don't think that's an expense. I would argue it's an investment. But anyway, I haven't been successful with that argument yet. But anyway, it's wine for me. It'd be apparel shopping for my wife. And it would be eating out for both of us. We both like to obviously eat out, and who doesn't? And also we separately account for two other expenses, gifts and holidays. So wine, shopping, eating out, gifts and holidays, I track on a monthly basis separately. Then with all other expenses, I put them into two different categories, discretionary and non-discretionary. I don't really need to worry about non-discretionary expenses because they are what they are, and we make sure that we're not overpaying on different things, insurance and all those sorts of things. But apart from that, that's all you need to do. And then I know what we want to spend on discretionary expenses, and we've got an annual budget for that. And we know to sort of track it to make sure we're kind of in line. And of course, we always are because, I'm a financial planner. But the process isn't time consuming. Look, sometimes it's a bit scary when you see those numbers in aggregate, but it allows us to make some really important conscious decisions, and we make sure we find a balance between investing a substantial amount of our income, but also investing a substantial amount of income in the things that we really enjoy. For example, travel and eating out are two things that we get to enjoy together that, are really important to us. And, we could be hit by a bus tomorrow, so there's no point sacrificing those things. If we can afford to do them and also still invest, then why not do them? And that's the empowering thing with managing your cash flow, is knowing where it's going and making these conscious decisions that, hey, we can put some money towards investing so that we're going to have a secure financial future. But at the same time, we can put some money towards enjoying today and getting the most out of life today, because who knows what happens tomorrow. So the first way to combat this cost of living crisis is make your spending visible. Otherwise, if you don't do that, it's impossible to manage. And I might just add here too that if you're reluctant to make it visible, you've got to ask yourself why. If you're reluctant to really do it, or you're making excuses for yourself not to track spending, it's not because you don't have time. I can guarantee it doesn't take much time. It's because you don't want to deal with the consequence or the decisions that you might have to make with that. Now, this is not a counseling session, but that's the reality of it. Most people don't want to jump on bathroom scales if they know that it's going to tell them that it's a scary number and they're going to have to lose weight and they're going to have to make some compromises that they're not ready to make. Similar to, maybe it's an outdated analogy, but, trying to convince someone to give up smoking, they're never going to do it until they're ready to give up smoking. So if you're reluctant to manage expenses, maybe just try and think about that a little bit deeper and why that might be. But, you really need to be doing it as a matter of course, as sort of prudent financial management. So apart from managing expenses, what else can you do? Well, maybe making some small sacrifices now might avoid the necessity to make some really large ones later on. So it might mean that you might need to pare back your living expenses, make some compromises, instead of going to Europe every 2 or 3 years, maybe push it out in 3 or 4 years or whatever it might be. It's going to be different for people's situations. Instead of going out for dinner twice a week, make it once a week. These sorts of things, maybe you can sort of pare back these expenses so that you can find some more money to invest to offset, the sort of cost of living. And you might make a promise to yourself that, you're happy to do that now, but if and when interest rates reduce, you can go back to your sort of normal spending pattern, if you like, to find that balance between, making a sacrifice today, but not necessarily having to make that sacrifice forever. And the second thing you might consider doing is taking more risk. If we need to build more wealth, if we need to chase a higher return, we might have to take more risk. And I'm not saying throwing darts at a dartboard. I'm not saying become a speculator rather than an investor. Still using an evidence-based, rules-based approach towards investing, of course, but maybe you've got to have more invested in growth assets. So shares and property. I did a podcast episode recently around, particularly for people that are young, why wouldn't they put all their super into the share market? Why do they have bonds and other defensive investments? Doesn't make a lot of sense. So it might be sort of an asset allocation thing, or it might be gearing. Maybe you've got to borrow a little bit more to build a little bit more wealth. If that's affordable and that's comfortable to do, of course. I'm not suggesting you go and borrow to your eyeballs and put yourself in a stressful situation, but you might have to, take on more risk. Doing the numbers, I've done the numbers many times in many different blogs. You can earn a sort of 13-ish% return if you're a long-term property investor just because of gearing. Well, 50% of that return's driven by gearing. So it's gearing, not property, that's really driving that attractive return, and just might have to be a little bit more aggressive from a gearing perspective in order to achieve your goals as a result of, that increase in cost of living crisis. So Stephen Covey wrote that really well-known book called 7 Habits of Highly Effective People. Great book. One of those 7 habits is begin with the end in mind, which is obviously really round about where am I heading, define the destination so then you can build the roadmap to get there. And so to apply that to a financial planning sort of situation, it really involves, working out, well, how much money do I need? As I said in that example, if you need $120,000 a year, you want to spend that 120 through to age 80 and then 70% of that amount through to 95, you're going to need $2.5 million. Okay, so that might be your number. Then you can work out how much do you have today? And obviously the difference is that gap you need to bridge, and you need to build a strategy on how to bridge that gap. And once you have that plan, at least you're going to feel comfortable that, I need to do A, B, and C. And if I do those things and execute really well, I've got a strong probability of achieving that goal, achieving that $2.5 million. That's $2.5 million in today's dollars, by the way. So, if you're 20 years away from retirement, it's going to be more than that. Should have mentioned that. Anyway, if you've got a plan, it gives you that comfort that you know exactly what to do and that you're heading in the right direction. Okay, so as promised, I'm going to add a Q&A section, and I have the first question today from Jason. So thanks very much for writing in, Jason. And just to let people know, if you've got questions, you can submit them to questions@investopoly.com.au, and I'll try and answer them here. So Jason asks, in one of your previous podcasts, you talked about mean reversion and how this could relate to not only property markets, but global share markets, helping determine which countries may provide better buying opportunities now for the long term. I've talked about mean reversion many, many times. I think we're probably bored of me talking about it, but yes, Jason, I certainly did. Anyway, he goes on to ask, how could we try to determine which markets would present good buying opportunities? What would be the top 1 to 3 markets at present where you would suggest has the highest potential over the coming decade? It's a great question. Unfortunately, I don't think it's one necessarily that I can say, look, go to this tool or look at this particular indicator. There's a lot more involved in it. You've really got to understand the geographical market, the makeup of the index, the pros and cons of that particular index, the different strategies that you can use to access that market. Not every geographical market has the same strategies just from a product perspective. And, what indexing strategies or rules-based strategies, probably better terminology, will suit that market conditions. So it's really difficult to give you a definitive answer here on how you go about deriving those markets. And I guess that's why people pay us money in order to do it. You've got to have a lot of experience and background in order to do it and do it properly. I just caution people, if you don't have that background and experience, don't try and do it yourself. Just go broad-based index. If you want to be a DIY investor, broad-based index, leave it the asset allocation to the professionals because you could completely mess it up. But in terms of answering your question, what are the 1 to 3 best markets at the moment? Well, the Australian market's pretty well valued relative to history. So some of the metrics we would use are CAPE ratio, which stands for cyclically adjusted PE ratio, sort of looks to smooth out earnings to identify multiple changes, valuation multiple changes. And of course, we know that the Aussie market generates a good level of income, which I think reduces its risk profile as well. Other sectors, the small cap and mid cap market in the US in particular, but I think just globally is very well priced. So small and mid cap. Now be careful with small cap. And this is why I say don't do it yourself, because small cap is higher volatility, higher risk. So you want to make sure that you're using the right product to you can't mitigate it, but you try and accommodate that risk as much as possible. And emerging markets are very well priced as well. So if I pick the best 3, I would say small and mid cap global, emerging markets, and the Australian market. Now don't take that as a guide to say I'll put a third of my money in each of those sectors. I mean, you could do that. I don't think that's probably the right approach. Unlikely to be the right approach for you, which is why I'm sort of saying you've asked a great question, but it's difficult for me to give you a general answer. And I don't want to mislead anyone into making, the wrong decision, of course. So thanks heaps for that question, Jason. It's a really good one. In fact, probably next week, my blog topic will be about what are the different indexing strategies that we can utilize and their pros and cons to sort of unpack that a little bit more. I think that'd be really interesting. As I said, if you've got any questions, just send them to me at questions@investopoly.com.au. And until next week, bye for now.